All right. Welcome back to another episode of The Long and Short of It. I'm Patrick Serezna.
And I'm Nick Galarnik.
All right, Nick, it's been a couple of weeks since we did an episode, but it's been crazy. The stock market had a huge shellacking to the downside, and we are now in the midst of some sort of a mean reverting rally. I want to talk about this. Now, what was interesting was the topic I wanted to cover, particularly today, was repair strategies. And I originally did a webinar. I featured it on Macro Voices and Market Huddle earlier. Was this idea that investors sometimes get trapped in a stock position. They did all the research, they did everything they wanted, and they buy a stock and they turn around and the market just shellacks them, goes against them. Now, often these investors don't want to sell at a loss, or they don't want to sell at as big of a loss. And they're looking for ways that they can repair this trade. And I figured, well, let's just do an episode on this and talk about it. I'd love to hear some of the insights that you have on it as well, on that. So what I want to do is specifically talk about a strategy called the ratio call spread. And so I did a special webinar. By the way, the recording of that webinar is still available at bigpicturetrading.com, completely free. Anyone just go to the homepage on the website. It plays right on there. And I talk about a real example I was using on Tesla. And it worked out perfectly because just earlier this week, Tesla had that rip to the upside, came right to the levels for the repair trade, and it's simply it was just a great repair. And we can't use Tesla now as an example, but anyone who wants to go back and watch it, they'll still be available for a few more days on the website, and so make sure you watch it. The one thing I want to talk, Nick, about is let's do a real example with a new stock. Because obviously Tesla, it's great to say in hindsight, but the thing that I like about this is that it's a way for investors to fix things without the long-standing tradition of dollar cost averaging. Everybody has done it once in their life, where basically you go and buy a stock and it gets hammered. Like, do you ever a dollar cost average, or do you condone it, or how do you approach it? Is it something that's not in your wheelhouse right now?
Depends on what I'm buying. Like, Google, for example, I dollar cost average some shares and some leaps as well, because I believe in that thesis long term. If it's like a trade where I'm in a trade short term and I don't think it's going to play out very well, based upon my thesis being validated, then I just cut and run. I say, okay, I'll look for the next trade. But, let's say, for example, we mentioned Google a couple of weeks back, and it went down to like a low of like $4 from $7. So the stop out didn't hit it at all, but now we're at like $5.50, right? So we're almost back to break even again. But it has so much time on it. Like, I bought June for a reason, right? We're only almost in April now. So we have April, May, June, 3 months plus earnings. So should I have maybe averaged down and bought those same positions at the lows? Perhaps, but I opted to go a longer term instead, right? If it's like a very short term trade where I'm looking at like a week out, then probably not. But if it's 6 months, a year out, where I'm long term bullish or bearish perhaps, and I want to build a position there, and it goes against me in the short term, like one example that comes to mind actually pretty well was right before COVID. I bought in the money ExxonMobil call options. I bought, I think it was the 60 strike XOM calls 2 years out. I bought them in February of 2020. So like right before that crash happened. And I paid like $12 per contract, because the idea was that I was creating a synthetic position on XOM. It was like $69, $70 a share roughly. I paid $2 of extrinsic premium 2 years out. And then the market sold off and crashed. Those calls went from $12 down to $1 a piece. Now, I thought to myself, I'm like, you know what? I bought for 2 years. Why not just hang on to these contracts? So what did I do? I bought a bunch more at $1 a piece. Got my average down to like $6 per contract. Within 8 months, those were worth $14 per contract.
That's awesome.
So I doubled my money pretty much. I sold off half my position, and then ultimately they went to like a high of like $30 each.
So now, what's interesting though is you are specifically talking about dollar cost averaging options,
Yeah, options. Yeah,
and that's actually very different than dollar cost averaging stocks, because the way I look at that Exxon example that you put, you had extraordinary symmetry. All those options went from $12 down to $1.
mm,
And for you to double your exposure didn't cost another $12. It
no,
cost you only $1. And
yeah,
so the convexity in the option is completely different. And therefore, that is a very unique situation.
it
And
is.
what one of the things that I highlight is actually there are multiple ways to repair stock positions. We're now talking equities, right?
Yeah, yeah,
And one of them, we cover a whole bunch of these at Big Picture Trading, but one of them is obviously buying options outright, like an example like you just gave. But there's all sorts of other combination trades that you can do. But when you dollar cost average with stock and just buy more stock,
yeah,
there's all these guys like the Jesse Livermores of the world, and the Dennis Gartmans and all the other guys that were basically like it's a cardinal sin to dollar cost average a losing position. And one
yeah,
of the rationales behind it is let's say put $100,000 into a stock position, and now you're down 20%. It's worth 80,000. You're 20,000 in the hole, and
mm,
clearly you're not willing to sell at a loss because you would have already sold it if you were going to. I mean, if you held it down 20%, it's because you somehow made it a long-term holding. And now what you're going to do is take what, another brand new $80,000 that's completely free to go into any other amazing investment that's selling
yeah,
at a discount, that's a better story, that's all these things, and you're going to tie it up into this other trade that's losing and trap it in the same situation with the other. So now if you're wrong and that stock goes another 10 or 20%, it's that much worse. A perfect example of that is Tesla. I'm going to put up a chart here. And what I want to highlight is, okay, like, so first what wave of Tesla's correction was from $480 down to 330, right? And any investor that saw their investment wipe out 33% off of their highs in 2 months was like, shit, it's a discount. The
yeah,
stock is a great blue chip stock. Why wouldn't I go thing? Anyone who doubled down and averaged their position down at $340, let's say, had to experience another 2 week drop that wiped out 40%
yeah,
from the already lower levels. Now imagine you doubled your position size thinking you were averaging your price, and then you get hammered by a 40% drop on a doubled position. And this is the trap of the traditional dollar cost averaging. And so let's talk about the strategy though. And the strategy to that I talk about to potentially be a way to repair this is using the ratioed call spread. And what this involves, Nick, like I'm sure you know, but let's just talk to our listeners here. What it involves is buying a call option and selling two higher strike call options.
mhm,
Now that's a combination with the stock. So let's go through a couple of basic things. Number one, the only way that you can do this strategy is if in your mind you are absolutely certain that you want to get out of the stock as close as possible to break even.
mhm,
You're looking for an exit on the stock, and it's not like, because a lot of times, like for instance, when you were using that Exxon example, when you were dollar cost averaging your options, you for whatever reason were bullish Exxon and wanted to hold it for a really extraordinary big move,
mhm,
right? You weren't looking for an exit. You weren't looking to repair the trade. You were looking to improve your position.
yes,
That's a very different situation than somebody who is upset that they're in the stock. They no longer want the stock, but
yeah,
the loss is too much for them to take and they don't want to take it. And so what they're looking for is an exit price that cuts the loss,
Yeah.
right? Like and so this ratio call spread only fits that criteria. Nobody should use the ratio call spread to average your position or something like that if you're long-term bullish to security and you plan on holding it,
Yeah.
because when it rallies, you're going to lose it. You're going to lose it with the ratio call spread. So why is it? Because what makes the ratio call spread amazing is often, not always, but often, it can be opened at zero cost,
Hmm.
and it requires no margin to put it on. So literally, you could put this ratio call spread on to try to repair your trade for no additional risk. And no,
Yeah.
it doesn't use the buying power, doesn't increase the chance of a margin call. It doesn't no other variable. It literally costs nothing to put it on, and that's what makes it wicked, right? Is that you literally can put on a repair trade and take no additional risk. I want to simulate this as an example right now, and so when you're in a difficult situation and you have, again, definitively decided that you want to get out of the stock at break even if it gives you the chance, then what this strategy does, so what does it accomplish? It gives you your break even at the halfway point of your loss. So if you lost 40 bucks on the way down, you only need a $20 recovery to get out of break even. In other words, you don't need it to go all the way back up $40 to get out of break even. You only need a small market bounce back to 20 to
Yeah.
get out of break even. And this gives you a much higher probability of exiting at no loss, and why it's a valuable strategy in today's market environment where it is increasingly looking bearish. And a lot of people got stuck holding stocks that in a losing position that they're not happy with. And they may want to use this strategy as a way to exit. So I picked a stock. I picked a stock to try repair. I don't have any of it, but I thought it was a perfect example of what would be a situation to use. And this is what I picked here was Lockheed Martin.
Yeah.
So these defense contractors, they've had big runs over the last couple of years during the Ukraine wars, and certainly some of them continue to run. Lockheed has been correcting counter trend to what a lot, because like if you look at ITA, which is the aerospace defense contractor ETF, along 52-week highs, right? Like, so defense contractors are not doing bad.
Yeah.
But Lockheed Martin, as a component of them, was
It's
in
doing bad.
basically a 6-month bear market, like a decline. I say bear market because it was been more than a 20% decline by at least that definition. It's 30% correction on the downside. Now, let's say someone saw that for the first time in 6 months, this thing starts closing above its 50-day moving average. Maybe has been breaking this descending trend line. Other defense contractors have been doing well. So I could imagine some trader in here may have decided to buy this, let's say, at 465 bucks, somewhere in the red circle, right? Like, so you went in there and said, this is a bullish opportunity. I think that this is the turn point in the stock. I'm going to take it long.
Hmm.
Then comes the announcement that the U.S. has chosen Boeing for its new fighter jet over Lockheed, and Lockheed lost the contract. And kabam, the stock wipes out from like 470, 480 bucks, basically down to $420 in 2 days,
Hmm.
right? Like just a blow to any investor who was looking for the turnaround in this stock. Now, let's say that this fundamental news shift has changed your conviction to be in Lockheed Martin. And you're like, forget this shit. I'm going to go buy Boeing. I'm going to go buy one of these other defense contractors that are working. I just want to get the hell out of Lockheed.
Yeah.
Okay. So this is a perfect example of where a repair strategy like this ratio call spread can be used as a way to exit this position. So let's kind of review where our this scenario is. So first, $465 is where, let's say, back in middle of March, an investor chose to buy their shares.
Mhm.
Today, the stock is 437. I'm going to call it the closest strike is 440 out of the
440,
money
yeah.
strike, right? And so you're sitting on a $25 losing position, right? You basically would need the stock to rally from 440 up to 465 in order to get out of the stock near break even.
Mhm.
And so what the key to doing a repair strategy is you're looking for the short strikes to be somewhere halfway to your break even. In this case, I'm going to pick on the $450 strike, but we can also look at the 455 strike as well. But the point is that you have your loss range, which is that between 440, 465,
Mhm.
and you're looking for your short strike to be somewhere in the middle of this.
Mhm.
Now, what the goal is for this Lockheed Martin in, let's say, in the next month to rally back toward $450 to get you out of this trade, and you're out at break even.
So would you go for May or would you go for April in this
Well,
case?
let's talk about this. This is actually a great conversation because you obviously, for me, I would want to do it as short as possible.
Yeah.
But as you know, when you go for out of the money strikes, they start the premiums massively contract as the probability distribution curve is much more narrow
Yeah.
on very short dated options, and so the bigger the loss, the wider your spread has to be, and the wider your spread is, the more time you have to add.
Yeah. So
So
let's just take a step back just for a sec, just for listeners. So like just to reiterate what your overall
mhm,
thesis is here on the strategy. Let's say, for example, you bought 100 shares overall on Lockheed Martin, right?
yeah,
And you're down now from, let's say your break even point is like 465, 470 ish. You're down now, let's say like 25, $30 per share.
right,
And so you're suggesting that we use a call ratio spread, which is where you buy one call option at a lower strike and sell two call options out of the money at higher strikes.
yeah,
And the reason why this doesn't elicit any margin impact is because you own the asset 100 shares, which is covered by one of those short calls. And then you're buying a call option, which is covered by one of those short calls as well. So
right.
you're short two call options out of the money. You're long one call option closer to the current price, and you're long 100 shares of stock as well.
So
And the idea would be that if it recovers up to like back to where it, or halfway back to where it was, you're going to profit because the skew of the options and the fact that you sell two against one enables you to have essentially a
right.
free position where if it doesn't do anything at all, you lose nothing. Actually, maybe make some money. And if it goes back up to where it was before, you profit immensely on the ratio spread.
Right. So I exactly you nailed the description perfectly. So let's actually simulate it out together. Here I have IB, and I want to just compare choosing different strike points. But what I want to highlight here. So here, let's say we have 100 shares of Lockheed Martin. Let's say you have this $43,000 position of the shares. Now we're looking at the April 17th expirations. So we're only going out 3 weeks,
Mhm.
right? Like this, we're going out like 25 days, whatever it is,
Yeah, yeah,
till expiration. A 440 call option. We would obviously try to split the spread, but it's right now 930, 980. So let's say you could naturally be filled 960, let's say,
yeah,
something like this.
yeah,
So I'm going to just demonstrate here by, let's say, going long one call option, which basically cost $1,000, right? Like
yeah,
900 here, 980 bucks. You can see last traded at 950. So we spent $980 buying this call option. So now this has given us a new long side exposure on the upside of Lockheed Martin to try to repair our loss.
yeah.
Now, The April 450s are 530 bid. So if I turn around and sell two of these at market, but let's say you can easily get 550 or
Yeah.
540 for these things. But if I come in here, I'm getting basically $1,100 income
Yeah.
on this. So in fact, I've opened this repair strategy at a credit. I actually am earning a positive carry for having this repair strategy open. Nothing out of money, out of pocket for me
Yeah.
on that cost.
I,
Now,
I no margin risk either.
and no margin risk, no nothing,
Yeah.
zero. As you notice, it's $1,000 in, $1,000 out.
Yeah.
We have no additional risk. Now, as an example, a 455 April is basically $4.
Yeah.
So now, if I wouldn't have needed, because my break even might have been higher, this is an example where it would cost a debit, where basically while it cost me $9.50 to buy the call, if I only got $4 credit for each call sold, I would only earn $8 of cash flow for the selling the calls, but paid 9.5 out.
Yeah.
So I paid $150 or $1.50 per share debit to have
Yeah.
it, but now the spread is wider. So a lot of people, when they do this strategy, obsess about wanting to do it at zero cost. I get it. Like psychologically,
Yeah.
there's something nice about it costing zero. But for you to be able to fix your position materially and it only costs you $1.50 per share, it's a pretty freaking good deal anyway. Like, so
Yeah.
I don't like to get always caught up in this. The only way I can do this trade is I find a way to do it at zero cost. Like, get over it.
Yeah,
Like, it's
especially when, because the idea here is that the alternative would be to average your position down, right? Like, let's say you bought
yeah,
at 460 or whatever, which is $46,000 for 100 shares. Right now it's at 438, 440, whatever, right?
yeah,
So if you were to buy 100 more shares, that's $44,000 additional outlay.
yeah,
So the suggestion here is that instead of doing that and averaging your price down to like 450, for example, you're using this ratio call spread instead, because if it bounces back to 450 and above, you're breaking even on the overall aggregate
yeah.
trade. But
Right.
you're not outlaying an additional $44,000. You're just you're
Bang.
actually pulling a small credit. So let's say, for example, fast forward a month, and LMT did nothing at all. You made $100 credit. All the calls expired worthless. Your price is the same. The cash that you had sitting there in your account that you would have used to average down your cost, maybe earn a bit of interest, perhaps, or perhaps you deployed it somewhere else where it bared more fruit, for example,
Right.
right?
Perfect. So let's simulate this out. So this is the big picture trading position simulator in the member section. And I want to highlight. So here I want to compare position one. Okay. So for this example, Nick, I know you're an options guy and all this stuff, but right now you're going to be position one. You're the guy that says, I don't know about this repair strategy. I'm going to just hold the stock.
Yeah.
So here you in position one only have 100 shares. Here I also have just the same 100 shares, but I did exactly this 440 by 450 out to April
Mm-hmm.
on this position. So when we calculate this out, you have $43,000 of stock and you need $2,500 profit or a $2,500 rise to get back to break even.
Mm-hmm.
I had to start the position simulator at this lower price, but we need to see a profit of 2,500 for you to be back to break even.
Yeah.
Over here, I have the same $43,000 of stock, but I bought the $9.50 call option and sold the $5 calls against it. And notice my capital outlay is the same. Now, here's the key takeaway. All right, let's talk about the risk scenario, which is what if Lockheed Martin basically continues to crash. And so let's just say this thing doesn't quit and ends up being at $380 in 3 weeks. It's not out of line. It's entirely possible,
It
right?
is possible, yeah.
And so let's just go over here and simulate that over those 24 days, the stock drops to $380. What's the key thing that I want to highlight? You're down 5,700 bucks. I'm down 55 to 5,700 bucks. The
Mm,
point being, I didn't take more risk by
yeah.
opening the call spread, right? There was no risk in
Additionally, yeah.
me using the spread in combination the stock. More importantly, if you dollar cost average the shares, and let's say you bought 200
200 shares.
shares, right?
I'm down
And we
double.
had to and doubled the position, now $87,000 of stock. If
Yeah.
the same move down to 380 happened, you would be down 11,500.
Yeah.
I'd only still be down 5.5, right?
Exactly. Yeah. Yeah.
And so right now, this is the scenario. So now I'm gonna just go back to 100 shares. Point I want to highlight is, how did the strategy do from a repair perspective? Well, if in those 3 weeks the stock rebounded back to $450 or better, you would be up 1,300 bucks on your shares,
And so would
but
you.
I'm up 2,500 bucks.
Yeah. Yeah. You're
Right?
up even
I'm
more. Yeah. Yeah.
basically, I'm at a break even.
Yeah.
The call exercise away my stock. I got out of break even. I did not need a rally all the way to 465,
Yes.
470. I only needed a rally back to 450 bucks, and I'm out of break even.
And the reason being is because that call ratio spread, when you think about it as a broken down position in concert with owning 100 shares, one call option short is a covered call against your shares,
Yeah, which is getting called away.
which is getting called away. And your second short call and long call essentially is just a call spread. It's a bull call spread,
Bull
$10
call
wide.
spread.
But the thing is that it's zero cost because you
Yeah.
sold two contracts. And yes, it is a ratio spread. However, I maybe call it a covered ratio spread because you own the stock that covers the second naked call
Yeah.
option.
Yeah. Basically, it's just a great strategy but where it's not a good strategy, and it has to be explicitly clear. If you're bullish the
Yeah.
stock and you want to hold it for the long term, you
Yeah.
don't repair your trade with this ratio call spread.
Yeah.
This ratio call spread is only good for someone that regrets being in the position and wants to get out at a better loss or a smaller loss, if not a break even, than what they're currently occurring. And they don't want to take any additional downside risks than they're already taking.
Yeah. Absolutely.
Right. And so this strategy was the one that I wanted to highlight. And yeah, so, that's the one, and so we like to show this stuff. Anyone that wants to, again, watch me do the video on this, it's on Big Picture Trading website. Just literally on the homepage, you can watch a recording. It's available for the next couple of days, so check it out. I
That's
don't know.
awesome.
So what is there anything else you want to chat about, buddy? Anything else we should touch on?
I mean, just broad markets overall right now. Like after the March OPEX, I was bearish into the March OPEX, rightfully so, and then into the April OPEX, I'm actually bullish. So I do think, barring any headline news from Trump, any changes with the tariffs, I actually think it's possible that the April 2nd tariffs are a bullish catalyst, because what I think may happen is that he might say, you know what, we're going to roll them back by a percentage, or we're going to push them out another month, in which case the market will rally on that. Seasonality is very, very bullish right now. So yeah, short term, I think we push. Again, like I'm not saying we're out of the woods by any means. I'm bearish, longer term, but I think short term bullish to like 5850, 6,000 on SPX is not unrealistic at all right now.
Yeah, actually, that level is exactly where I'm watching the more or less 5,900 area. But my view, and actually, we should maybe just briefly talk about this before we wrap up, because Kevin Muir, who I do the market huddle with,
Love Kevin.
was talking about the JP Morgan whale, which is the guy that does the big SPX collars to 25 billion notional.
Yeah.
All of the strikes that I think it was the 55.65 put strike on the S&P was where the puts were open. Like there's like 40,000 contracts to the March 31st expiration. The point being that those puts were giving a charm, which is one of the more sophisticated Greeks,
Yeah.
giving a charm tailwind.
Yeah.
And what the charm means is that when time is passing, the probability distribution curve on the possible outcomes of the market
Titans.
tightens,
Yeah.
and all of those options that are farther out of the money, their
Yeah.
deltas shrink.
Yeah. Yeah.
Right,
That's
the
right.
at the money delta will stay at 50 cents,
Yeah.
but all the out of the money ones start shrinking, and therefore the dealer that has to have all of these huge SPX or S&P future
Yep.
shorts out there, well, every single day they're buying back a certain amount of these futures because of the charm effect.
Yes.
And so we now have a scenario where this week it's a bullish tailwind.
Yes. Yes.
What's interesting is that all rolls off on the 31st.
And yeah, and
Basically,
that'll be reset.
on
Yeah.
it's reset, and it just so happens that's within the day of the tariff thing, and
Mm.
so what's really interesting to me is maybe the scenarios we hit that upper target you're talking about 5,900 this week,
Yeah.
and maybe that the roll off of this and some Trump scare could actually be where we have potentially a turn point that isn't line up with the April 17th OPEX. And maybe it
Yeah.
is actually much more in line with the quarterlies. Just a thought. We'll see which way it plays out. But at least that's one of the other factors that's out there from an options perspective that people need to consider.
Yeah, for sure. Yeah. And, as always, obviously, for all our listeners, like managing your risk is really important. I keep seeing people just take these stupid bets and blowing, 6-figure accounts. I saw one guy blow like 470K in 2 trades last week. I just don't understand it. You can manage your risk. The name of the game really is, at least for options, from my perspective, trading shorter term, is keep your risk really small. And if you lose, it doesn't matter too much. But if you win, the winnings will cover, 4, 5, 7, 8 losses and then some, right? So you don't really it's nice because from a psychology perspective, you're not ever in the area of turmoil mentally where you're hemming and hawing about your decision making and you're feeling regret and maybe despair. Even when you're losing, like when I'm sitting in a losing period, like Google, for example, the call spread I mentioned a couple of weeks ago, I don't even care. Like I'm sitting here, I'm like, you know what? I got 3 months of time. I'm sitting fine. I'm down $2 per contract. Not a big deal because I'm managing my risk. But if for example, you're all in at the position and you're down 50%, that's a big hole to get out of.
Yeah.
Right? So again, I can't stress enough that managing your risk really is the most important part of option trading and trading overall.
Yeah.
And you know what? If you know how options operate, you have a much greater leg up in that respect. If you don't,
Love it.
I would say maybe paper trade, or do some more reading, talk to someone like Pat or myself, and that's how you're going to become a much more independent thinker and independent trader as well.
On that, Nick, where can they find you, buddy?
Optionfinity.com. It's a link is below in the YouTube channel. That's pretty much it. I don't have any social media at all, so.
And check out my recording, guys. All right, it's at bigpicturetrading.com. Listen, Nick, it was a great episode. Looking forward to hitting you up again with a couple of weeks for another one.
Likewise, Patty.
Cheers, everyone.
Later, guys.